Good morning to CMC Espresso. The Federal Reserve will likely raise interest rates in June if economic data points to stronger second quarter growth as well as firming inflation and employment, according to minutes from the US Central Bank's April policy meeting released on Wednesday. That view, expressed by most Fed policymakers at the last policy meeting, suggests the central bank is much closer to lifting rates again sooner than Wall Street expects. Markets reacted by pumping up the dollar and selling gold and stocks. Just in that moment, Goldman Sachs is coming out and downgrades equities to neutral over a 12-month time horizon on growth and valuation concerns. Neither of these concerns are new. Not only has earnings growth been negative, but long-term expectations for earnings growth has been lackluster. Valuations have been and are elevated. FactSet statistics show that the forward 12-month price earnings ratio is 16.6, which is well above the 5-year average of 14.5 and a 10-year average of 14.3. All of this is in the context of what one would expect to be a rising US dollar environment. The more the dollar climbs, the more the Chinese yuan will appreciate, and traders might start to fear again that unsustainable capital outflows out of China will force a more sudden yuan devaluation. This was the cause and effect of the last two market routes that we had in summer of last year and the beginning of this year. Panic started in January when the rate climbed above 6.56 yuan per US dollar. Today's fix is just shy of that level. Meanwhile, a Bank of America Merrill Lynch fund survey shows that China is no longer the world's biggest black swan. The Brexit is now perceived by fund managers as the biggest tail risk by 27% of those surveyed. So one must wonder about the logic in the June rate hike by the Fed, should it come, which would be just 1 week ahead before the Brexit vote. Hiking a week before the UK vote seems like a totally unnecessary risk that is extremely would be unusual for this risk-averse Federal Reserve.